I would like now to introduce my partner, Jim Elcock, President of Colliers. Jim will provide an overview of the current market conditions and projects for 2017, as well as introduce the panels for the program. Jim.
Good afternoon, and I echo Tom's sentiments. Thank you all for joining us this afternoon. We're all glad you're here. This year's theme is shifting gears, and the phrase resonates with us here at Colliers for a number of reasons. The national economy continues to act as though it's slipping a gear. Office investment sales in the city of Boston has downshifted for the first time this cycle. It was an election year with results that surprised many. Interest rates are on the move. The Dow is approaching 20,000. And last but not least, we are sharing the convention center with a car show today. The commercial real estate market in Greater Boston is dynamic, to say the least. And with some markets that are stuck in neutral, others are in overdrive. Some markets are emerging, tenants are moving, and the fundamentals are shifting as a result. With this backdrop, I thought it would be appropriate to change the format of this year's seminar. This evening, as Tom alluded, you'll hear my brief remarks, and then I will introduce you to a number of talented individuals that make Colliers what it is today. Coupled with the video montage you just saw, and followed by Kim Sherman's remarks, you'll be well poised to fight the traffic and head out to 2017. Market summaries. This year has been an up and down for the Boston market. Vacancies moved up to 11.3%, which is we now have close to 1 million square feet of sublease space, and total absorption ended the year in red. Despite the backdrop, landlords continued to push rents throughout 2016, and hundreds of tenants are still searching for space with requirements over 5 million square feet. Across the river in Cambridge, the office and lab market is hotter than ever. Tenants are struggling to find space to expand, and with little new product coming online, availability should stay tight. Firms such as Shire and Akamai have gobbled up space that didn't even hit the market. Conditions will keep the landlords in the driver's seat and push more companies to neighboring submarkets such as Waltham, Watertown, Boston, and Lexington. The suburban market ended the year on a positive note with absorption of 1.7 million square feet. This was about 25% below of what it was in 2015, but still well above the average absorption of the 7.5-year economic cycle. Performance varied widely by submarket and also by cities and towns. Built-to-suit construction was a primary driver activity in the inner suburbs, with both the FBI and Partners Healthcare opening up new headquarters, bolstering the future for these emerging submarkets. Now let's move to the 2017 projections. As I mentioned in my opening paragraph, it would be irresponsible to discuss 2017 without acknowledging what happened this past November with the presidential election and even the local ballot questions we faced here in Massachusetts. Whether we had a strong feeling about our next president, casinos, charter schools, animal cruelty, or marijuana, to say that we were surprised might be an understatement. As my 85-year-old mother says, who I speak to every day, the day after the election, quote, "Jimmy, I can't believe I did so poorly at the polls. I only got the animal question right." With Trump's election, there's a sense of cautious optimism within the business community. Many at this point don't see a downturn till the end of 2018. And even though our current recovery has been somewhat erratic and slow, most have enjoyed the ride. And clearly, in Massachusetts, the engineering firms and the software firms that deal with defense and infrastructure are feeling very good about this pro-business environment. Conversely, if Washington were to repeal the Affordable Care Act, many of the hospitals and insurance companies that we work with are a little bit hesitant as to how to move forward, not knowing how a repeal might deal and affect the reimbursements. But coming back to real estate, a car needs 4 wheels to make it go. The same applies to real estate, where demand, supply, rent, and capital investment are the wheels at which make the market operate. Let's start with the demand side of the equation. First point, You're going to see more and more suburban tenants on 128 and on 495 starting to focus on an urban outpost in Boston or the urban core. Not everyone can make a wholesale move of their operations, but they still want access to the talent and vibe that the urban core has to offer. The Seaport has been the main beneficiary of this trend on both parts. As you heard, with the likes of GE, Reebok, and Autodesk relocating wholesale, while Red Hat picked the Seaport for its urban outpost to complement its Westford, Massachusetts operation. It's also interesting to note that we're becoming the footwear capital of the East Coast, as you see on the map in front of you. So perhaps if my driving theme doesn't really work, next year we can talk about what a walkable city we are. Right-sizing, second point, will remain front and center for tenants and a challenge for the landlords. Tenants coming to the market, regardless of what sector, from law to technology, want to maintain and get efficient floor plans by leasing less space and expecting, even demanding, that the building or the park common areas handle so much of the amenities needed for tenant satisfaction. And what you are seeing is that even with the rents rising over the last several years, when tenants are taking less space, there has been a flight to quality, which has been helpful, though, because in the overall scheme, the cost of labor has increased dramatically over the last 4 years. And finally, high-rise space will continue to struggle as low-rise and buildings with character are outperforming in the city. Financial district vacancies above the 20th floor, have never been higher and currently have a vacancy rate of 20%. We don't expect to see a major recovery in this vacancy in 2017. Switching to the other side of the ledger, the tenants do need somewhere to go, and the development and repositioning of assets all needs to be closely watched. Let's talk about supply. Close-in urban development remains a key focal point. North Point could provide a relief valve for the white-hot Cambridge market. The continued reinvention of North Station should gain further traction throughout the year. And meanwhile, across town, it appears that the South Station Tower is making true progress. In Cambridge, the future of Kendall Square is coming into focus. As you know, the Volpe Center was awarded at the end of 2016 to MIT. Given today's marketplace, it shouldn't surprise anyone in this room if the Kendall Square initiative gets fast-tracked. In the suburbs, there's 2 projects to keep an eye on. The Center at Innovation Drive in Tewksbury will determine the viability of renovated space out on the 495 belt, while the Post in Waltham will be a bellwether for rents as well as the repurposing of space in the core 128 market. And finally, expect to see built-to-suit activity for the flex and industrial users. Tenants are becoming frustrated with the lack of quality options within this product type. As you think of the dynamics between supply and demand as the 2 front wheels of our real estate automobile, we now should focus on rents and capital investments. Rents. Across the market, we are seeing a flattening of rents. 95% of the market is plateauing, with select pockets of outsized gain in the remaining 5%. Already, we've seen resistance in both the Back Bay and the Seaport market. Landlords are fighting to keep their face rate, but they're doing that by offering more concessions in the form of improvement allowances and free rent. Expect to see more of this going forward as landlords are getting more and more creative to fill that vacancy. And with today's backdrop, it's hard to defend rent growth. The unemployment rate in Massachusetts is 2.9%, the lowest it's been since 2001. Employers continue to struggle to find quality workers, and they're not able to grow as quickly as they would like. This forces them often to hold back on their expansion, which in turn does take away some of the leverage landlords otherwise would have had. Traffic, as you've heard, and transit accessibility remain on the top minds of many of these employers. And in areas such as the Seaport, which is one of our hottest submarkets, the narrative has been shifting in the sense that they will probably not be able to continue with their 7% rent growth year over year. In addition, Remember this stat. There are 180 buildings in our marketplace, Boston, Cambridge, and the suburbs, that all have at least a 20,000 square foot block that's available today. Rents are about as high as they are going to get in this real estate cycle, in our opinion. Finally, investment sales. This is the product type and how it all comes together. Market-wise, the office sales volume has peaked, and 2016 marked the second year of falling investment volumes. Yet the city of Boston has bucked this trend. It established itself as a top global market of investment volume, but the dollar volume has peaked. 2016 marked the first year in the real estate cycle where the volume did not match or exceed the prior year's figure. And more than half of the Class A buildings have sold at least once in the past 5 years. The ownership is changing. This patient capital, with 46% of all sales having some form of foreign investment stake, while more than two-thirds could be categorized as long-term owners. And unless buyers get more aggressive, there will be fewer buildings available to buy over the next 12 months. In conclusion, as this market overview, we do enter the year with cautious optimism. Key industries such as healthcare and sectors are likely to tap the brakes, while defense contractors and tech firms will accelerate. Employers, investors, and developers need to be mindful with what is happening around us. The U.S. has never had an economic cycle which has lasted longer than 10 years. We cannot just sit back and let our autonomous vehicle do the driving. 2017 could be our last chance for healthy GDP growth this cycle. The year ahead will offer many chances for big wins and major headlines. To provide further content and discussion, I would like to now introduce the first of our two panels who will answer some of the questions that you've all been waiting for.